Good morning. I am Maria J. Sapanlili of Group 2 and we will be presenting Working Capital Management. Our topics are: what is working capital? The scale of working capital, managing inventories, managing trade receivables, managing cash, managing trade payables, and I was assigned to the definition of the working capital. So what is working capital? Working capital is the difference between the current assets and the current liabilities. It represents the amount of money a company has available to cover short-term obligations and expense. Working capital is an important metric to assessing the company's financial health as it provides an, an indication of the company's ability to meet its short-term obligations and fund its day-to-day operations. A company with positive working capital has more current assets than current liabilities, which means it has enough resources to meet its short-term obligations without having to rely on external financing. Conversely, a company with negative working capital has more current liabilities than current assets, which means it may struggle to pay bills and fund its operations. In this case, the company may need to borrow money to raise capital to cover its short-term obligations. Working capital means the amount required on a day-to-day business operations. The current assets are liquid assets. It is a short-term assets that the company expects to use up, convert into cash, or sell within one fiscal year or operating cycle. While the current liabilities are those liabilities which can be paid to respective parties within 1 year or less than 1 year at their maturity. A positive working capital indicates that the company has enough cash and other liquid assets to cover its short-term debts. A negative working capital means that the company has some more short-term debts than liquid assets, which could lead to financial trouble. Working capital samples. There are actually three: the current assets and the current liabilities. For the current assets, those are cash in hand and at bank, trade receivables or account receivables, inventories, prepaid expenses such as insurance premiums, advance payment on future purchases, etc. While the current liabilities are all liabilities that are due within a year of the balance sheet date. It includes the trade payables or the account payables, bank overdrafts, taxes payable, interest payable or loan principal that must be paid within the year, deferred revenue such as advance payments from customers for goods or services that are not delivered, etc. The working capital formula. It is actually the current asset minus the current liabilities, which means the working capital is equals the current assets minus the current liabilities. For example, a company has a current assets of 10,000 and has a 3,000 current liabilities. The working capital for that is 7,000. Types of working capital. It is categorized into six. The first one is the gross working capital. It is actually referring to the total current assets of a company, including the cash, accounts receivable, inventory, and other short-term assets. It represents the company's ability to meet short-term obligations. Number two, net working capital. It is actually the current assets minus the current liabilities. It indicates the company's liquidity position after considering its short-term obligation. Positive net working capital indicates that the company has enough current assets to cover its current liabilities. Permanent working capital. It represents the minimum level of investment required in current assets to support the ongoing operations of a company. It includes the funds necessary to maintain minimum levels of inventory, accounts receivable, and cash reserves to meet day-to-day operational requirements. Number 4. Temporary of variable working capital. It refers to the additional working capital needed to meet seasonal fluctuations, unexpected surges in demand, or other temporary requirements. It represents the difference between the peak and base levels of working capital during business cycles. Number 5. Positive working capital. It indicates that the company has sufficient current assets to cover its short-term obligations. It is a favorable position that reflects the company's ability to manage its day-to-day operations and meet its financial obligations. Number 6. Negative working capital. It occurs when the current liabilities exceeds its current assets. This situation is considered unfavorable as it suggests that the company may face difficulty in meeting its short-term obligations. Here are some ways that businesses can manage their working capital. It increases sales. This will generate more cash flow, which can be used to pay off debts and increase working capital. It reduces expenses. This will free up cash that can be used to increase working capital, improve inventory management. This will ensure that the businesses have the right amount of inventory on hand, which can reduce costs and improve cash flow. Extend payment terms to customers. This will give businesses more time to collect payments, which can improve cash flow. Negotiate with suppliers. This may allow businesses to get longer payment terms, which can improve cash flow. Take out loan. This can provide businesses with the cash they need to increase working capital. In conclusion, working capital is a vital aspect of financial management that businesses must prioritize. By effectively managing working capital, companies may ensure smooth operation, seize growth opportunities, and enhance their financial health. Thank you.
Good morning to Professor Ben Gallego, to all of us who gave to today's class. Good morning, teacher. My name is Sherilyn Gimarado. I belong to Group 2. And in this presentation, we'll explore the second topic of the working capital management, the scale of working capital. For the subtopics, the discussion will focus on the working capital management issues, the three main components of cycles of working capital, and lastly, the factors that can affect the scale of working capital. On to our discussion. We already discussed the basic definitions and some salient information about the working capital. Now let us have parallel information and a definition of the scale of working capital. What is the scale of working capital? We know that it is a crucial aspect of financial management. It also refers to the magnitude or size of the working capital held by a business. The scale of working capital requirements can indeed vary greatly among businesses and industries. Several factors contributed to this variation, including company size, the nature of operations, sales volume, and financial management practices. Let's explore each of these factors in more detail. First, the company size. Larger companies often have more extensive operations, including larger inventories, higher sales volumes, and a larger customer base. Consequently, they tend to have higher working capital requirements compared to smaller companies. Second, nature of operation. The type of industry and the specific operations of a business play a significant role in determining its working capital needs. For example, a manufacturing company typically requires significant investment in raw materials and inventory, resulting in higher working capital requirements. On the other hand, a service-based company may have lower working capital requirements as they may have minimal inventory and faster cash conversion cycles. Next is the sales volume. Companies with higher sales volumes generally have greater working capital needs. When sales increase, businesses need to invest more in inventory and accounts receivable to meet customer demand. This increased investment ties up funds in working capital. Last is the financial management practices. The effectiveness of a company's financial management practices also impacts its working capital requirements. Efficient management of accounts receivable, inventory, and accounts payable can help optimize working capital. For instance, implementing effective credit policies to reduce the collection period for receivables or negotiating favorable payment terms with suppliers can help free up cash and reduce working capital needs. Please note that it is important for businesses To carefully analyze the working capital requirements and ensure they have adequate liquidity to support their operations. Proper management of working capital is crucial for maintaining a healthy cash flow and sustaining business operations effectively. Working capital management ratios. What is this? These are financial metrics used to assess a company's ability to effectively manage its working capital, which is the capital used in day-to-day operations. These ratios provide valuable insights into a company's liquidity, efficiency, and financial health. In this portion, we'll explore some key working capital management ratios and their significance. The three ratios that are important in working capital management are the following: the working capital ratio, the collection ratio, and the inventory turnover ratio. Let us first tackle about the working capital ratio, or also known as the current ratio. It is calculated by dividing current assets by current liabilities. The current ratio is a key indicator of a company's financial health as it demonstrates its ability to meet its short-term financial obligations. A working capital ratio below 1.0 often means a company may have trouble meeting its short-term obligations. That is because the company has more short-term debt than short-term assets. Working capital ratios of 1.2 to 2.0 are considered desirable as this means the company has more current assets compared to current liabilities. However, a ratio higher than 2 may suggest that the company is not effectively using the assets to increase revenues. For example, a higher ratio may indicate that the company has too much cash on hand and could be more efficiently utilizing that capital to invest in growth opportunities. An healthy working capital ratio is typically between 1.5 and 2.0. This means that a company has 1.5 to 2 times as many current assets as current liabilities. A higher ratio indicates that the company has a strong liquidity position, while a lower ratio suggests the company may have difficulty meeting its short-term obligations. Next is the collection ratio, also known as days sales outstanding or DSO. It is a measure of how efficiently a company manages its accounts receivable. The collection ratio is calculated by multiplying the number of days in the period with the average amount of outstanding accounts receivable. Then, this is divided by the total amount of net credit sales during the accounting period. To find the average, another important metric of working capital management is the inventory turnover ratio. To operate at maximum efficiency, a company must keep sufficient inventory on hand to meet customers' needs. However, the company also needs to strive to minimize costs and risk while avoiding unnecessary inventory stockpiles. The inventory turnover ratio is calculated as the cost of goods sold divided by the average balance in inventory. Again, the average balance in inventory is usually determined by taking the average of the starting and ending balances. These ratios serve as valuable tools for assessing a company's working capital management. By analyzing these ratios over time and comparing them to industry benchmarks, investors and stakeholders can gain insights into a company's financial performance and its ability to meet. In addition to the ratios discussed, companies may rely on the working capital cycle when managing working capital. Working capital management helps maintain the smooth operation of the net operating cycle, also known as the cash conversion cycle or CCC. It is the minimum amount of time required to convert net current assets and liabilities into cash. The working capital cycle is a measure of the time it takes for a company to convert its current assets into cash. How to how do we get the working capital cycle? Inventory cycle plus receivable cycle less payable cycle equals working capital cycle increase. There are three main components of the working capital cycle. First, the inventory cycle. This refers to the time it takes for a company to convert raw materials into finished goods and then sell them. It starts with the purchase of raw materials, followed by the production process, and ends with the finished goods are sold. Second, the accounts receivable cycle. After the sale of goods or services, the company generates accounts receivable, which represents the amount customers owe to the company. The accounts receivable cycle is the time it takes for the company to collect payment from its customers. The third one, accounts payable cycle. This cycle involves the company's payments to its suppliers for goods and services received. It starts with the purchase of raw materials or inventory and ends with the company makes the payment to its suppliers. The overall working capital cycle is the sum of the inventory cycle, accounts receivable cycle, and accounts payable cycle. It represents the time it takes for the company to convert its investments in inventory and accounts receivable into cash while also managing its payment obligations to suppliers. Managing the working capital cycle is crucial for businesses as it impacts their cash flow, profitability, and overall financial stability. By efficiently managing each component of the cycle and reducing the time it takes to convert assets into cash, companies can enhance their liquidity position and optimize their working capital management. Here are some additional factors that can affect the scale of working capital. First, the nature of business. The first factor which helps in determining the requirement of working capital is the type of business in which the company is involved. A trading company or a retail shop requires less working capital as the length of the operating cycle of these types of businesses is small. However, the wholesalers require more working capital as they must maintain large stock and generally sell goods on credit, increasing the. Another factor is seasonality. Seasonal factors can impact the scale of working capital for businesses by affecting sales variation, cash flow patterns, accounts receivable and payable, production and labor costs, and financing requirements. Seasonal businesses may experience fluctuations in sales, requiring higher investment in working capital during peak seasons and reducing it during off-peak seasons. Next factor, the sales volume. The sales volume is a crucial factor in determining a business's working capital as it affects various aspects such as seasonality, inventory management, cash flow, and operating efficiency. Seasonality and sales fluctuations can lead to increased working capital requirements, while slow periods or slow sales volume can decrease them. Another factor that can affect the scale of working capital is the credit policies. Credit policies significantly impact a company's working capital. Factors such as credit terms, credit standards, collection policies, bad debt provisioning, credit monitoring, supplier credit terms, and cash discounts can affect working capital. Longer credit periods and lenient terms can tie up more capital in accounts receivable, while lenient standards increase the risk of bad debts and working capital recovery. Next is the supplier relationship. The last one is the relationship with the supplier. Supplier relationships can significantly impact the scale of working capital, particularly in the accounts payable component, negotiating favorable payment terms, discounts, supplier reliability, Price negotiation and supplier diversity can help companies manage their inventory levels and working capital requirements. Reliable suppliers ensure a smooth chain of supply, reducing disruptions and improving revenue generation. Price negotiation can lead to favorable pricing arrangements, resulting in higher profit margins and improved cash flow. Diversifying the supplier base can mitigate risks associated with relying heavily on a single supplier, reducing the risk of supply chain interruptions and maintaining a stable working capital position. In conclusion, we can say that working capital plays a vital role in the financial health of an organization. The scale of working capital depends on the industry business dynamics and growth objectives, and working capital management involves tracking various ratios, including the working capital ratio, the collection ratio, and the inventory ratio. That ends my report. I hope you get something relevant from this. Thank you all for your attention. Thank you all for listening.
Okay, good morning po sa ating professor and good morning classmates. I'm Joanna Paula C. Castillo from Group 2 and for today I'll be reporting the topic managing inventories. So inventory means stock of goods like raw materials, work in progress, finished goods, and consumables. While on the other hand, inventory management means planning, organizing, handling, and storing adequate level of inventory with optimized cost to meet consumers' demand. So it is an important task for businesses of all sizes as it can help to ensure that they have the right amount of inventory on hand to meet customers' demand without overstocking or running out of stock. Next is inventory management helps companies identify which and how much stock to order at what time. It tracks inventory from purchase to the sale of goods So the practice identifies and responds to trends to ensure that they always have enough stock to fulfill customers' orders and proper warning of a shortage. So there are two most significant costs involved in managing inventory. The first is the ordering cost, and the second is carrying cost. The inventory occupies 50 to 80% of the current total asset of the business, and it is a very essential part of the working capital management and production management. So there are procedures and techniques in managing inventories. So the first one is forecasting future demand. So this means preparing appropriate projections or forecasts, as it is one of the best ways to ensure that inventories will be available to meet future production and sales requirements. Next is the financial ratios. So one ratio that can be used to help monitor inventories levels is the average inventories turnover period ratio. So the sample equation here in our reference is average inventories turnover period equals the average inventories held over cost of sales multiplied by the number of days in a year. So the ratio provides a picture of the average period of which inventories are held. This can be useful as a basis for comparison. The average inventories turnover period can be calculated for individual product lines as well as for inventories as a whole. Next procedure is what we call the recording and reordering systems. So a sound system of recording inventories movements is a key element in managing inventories. So there should be proper procedures for recording inventories, purchases, and usage. Um, periodic periodic checks should be made to ensure that the amount of physical inventories held corresponds with what is indicated by the inventories record. And the last one is the levels of control. So the ABC, I think this is not the last one. The ABC system of inventories control is based on the idea of selective levels of control. So a business may find it possible to divide its inventories into three broad categories A, B, and C. So each category will be based on the value of inventories held. So here in our example, category A contains inventories that, though relatively few in quantity, account for a large proportion of the total value. Category B, inventories consist of those items that are less valuable but more numerous. And category C comprises those inventories items that are very numerous but relatively low in value. So different inventories control rules would be applied to each category. And ayun, tama ako. So yun yung last, yung level of controls. Now we will move on to the inventories management models. Next slide na po tayo. Ayan, the first inventory management model that we will discuss is the economic order quantity. So the economic order quantity, or the EOQ model, is concerned with determining the quantity of a particular inventories item that should be ordered each time. So in its simplest form, the EOQ model assumes that the demand is constant. So this implies that inventories will be depleted evenly over time to be replenished just as the point that they ran out. So these assumptions would lead to a sawtooth pattern to represent inventories movements. The EOQ model, which can be used to derive the most economic order quantity, is EOQ equals square root of 2DC over H, where D stands for the annual demand of the inventory's item. So this is expressed in units of the inventory's item. C is the cost of placing an order, and H is the cost of holding 1 unit of the inventory's item for 1 year. So the next model is the what we call enterprise resource planning system. So the enterprise resource planning, or ERP systems, provide an automated and integrated approach to managing a business. They consist of a suite of software applications or modules that record, report, and analyze and interpret data for a range of business operations, including production, marketing, human resources, accounting, and inventory management. An ERP software application for the management of inventories will carry out a wide range of tasks, such as first, forecasting demand using statistical formula, making reorder decisions based on forecast future demand, ordering the transfer of goods between locations, tracking and reporting inventories according to type, serial numbers, and so on, providing real-time information concerning shipping costs, trends in inventories holdings, on-time deliveries, and so on, allocating warehouse space for where goods are to be stored, helping inventories audits by setting tolerance levels for variations between actual and reported inventories held, and last is pricing inventories being shipped to take account on required profit margins, bulk discounts, and so on. The next model is the what we call just-in-time inventories management. So the essence of JIT, as the name suggests, is that to have supplies delivered to the business just in time for them to be used in the production process or in a sale. So by adopting this approach, the inventories holding costs rest with the suppliers rather than with the business itself. And the last management model is the XYZ inventories management. So XYZ inventories management classifies inventories into three categories according to variability of customers' demand. So category X items are those that display relatively little variation in demand over time. In other words, sales follow a fairly steady path. This pattern of sales demand makes it possible to produce forecasts with a high degree of accuracy. Category Y, items items display greater variability and demand. So sales of these items may be affected by seasonal factors, changes in the competitive environment, and changes in interest rates, and so on. And category Z, items display a high level of variability in demand. So ends my report, and thank you for listening.
Managing trade receivable. Allow me to define to you what is a trade receivable. Trade receivable defined as amounts owed to business by customers for goods or services that have been delivered or rendered, or money owed to a firm for goods and services sold on credit. So, in managing trade receivable, the following objectives are to maximize the return of investment in receivable, to maximize the sale to the extent of acceptable risk, maintain updated record, accurate billing, establish credit policies. Managing trade receivable effectively can be challenging, but it is essential for the financial health of your business. By following best practices, we can help to ensure that you receive payments on time and that your business has a healthy cash flow. Managing trade receivables incur costs. These costs are as follows: costs incurred in arranging additional funds to support credit. Example, interest. Costs incurred in credit administration or yung mga salaries ng mga administrator in collecting this receivable. Bad debts. Bad debts refers to receivable that are no longer collectible. In managing trade receivable, we have the following issues to consider in the creation of credit policy. One, which customer should receive credit? How much credit should be offered? What length of credit is prepared to offer? Offer discount for prompt payment. What collection policies should be adopted? How the risk of non-payment can be reduced. So next. In the assessing and monitoring the customer's credit worthiness, these five C's of credit, these five C's of credit are helpful in credit analysis. One, capital. Two, capacity. Three, collateral. Four, conditions. And five, character. Capital refers to the financial condition of a firm as indicated in its financial statement, while capacity refers to the customer's ability to pay as determined in the part of customers' past records or business methods. Collateral refers to the asset that customers may offer as security in order to obtain credit, while condition refers both on the general economic trends and to the special developments in certain geographic regions or sector that might affect customers' abilities to meet their obligation. While last, character refers to the probability that customers will pay their debts. This includes background checking. Background checking through people in firms from past performance, other supplier, customers, and competitor. These five C's of credit are useful in evaluating a potential borrowers. So next, while you already identified the person that are potential borrowers, the question follows how long or the length duration of credit period. These items are factors in consideration in considering the length of credit period to be granted are as follows. 1. Typical credit terms operating within the industry. The degree of competition within the industry. Bargaining power of a particular customers. Risk of non-payment. Capacity of the business to offer credit. Marketing strategy of the business. Decision of credit depends on cost-benefit analysis. A positive benefit or a negative benefit. So next, another way to address the early collection of receivable, some agencies offer discount for prompt payment, like cash discount, debt factoring, invoice discounting, and credit insurance. Cash discount refers to an incentive that seller offers to a buyer in return for paying a bill before the scheduled due date. Example, Company X allow buyer for a 10 days period of payment. If the buyer pays within or shorter than 10 days, are given 1% discount or possible a higher rate. So next, while debt factoring or invoice factoring, these two methods, debt factoring, invoice factoring, uses third party. This third party pay you in advance or collect the receivable to customers, given in return that the amount you receive is deducted with agency fee or uh, a percentage fee. While trade credit insurance uses a third party, an insurance company, ensuring that in case the buyer fails to pay, it is the insurance company will pay, subject, of course, to approval. Now, next. Collection policies. These collection policies ensures that receivables are collected as quickly as possible so that non-payment risk is minimized and operating cash flow are maximized. These various tests are as follows. Develop customer relationship. Publicize credit terms. Issue invoice promptly. Use financial ratios to monitor outstanding receivable such as yung average settlement period for a trade receivable or trade receivable to sales. These two financial ratios are useful in monitoring the outstanding receivables or the number of days to turn the receivable into cash. Another one is to produce an aging schedule of receivable. This aging schedule of trade receivables are helpful for managers to see the pattern of outstanding receivable. This aging of trade of receivable is also helpful in knowing the credit amount granted to an individual company. Another one is identify the pattern of receipts. This uh, will help a manager or us in knowing what period or month sales have increased. This will help the needed working capital in an agency. Another thing is to answer queries quickly. And last, deal with slow payers. So next, reducing the risk of non-payment. Efficient collection policies are important in reducing the risk of non-payment. These ways are to reduce the type of risk. Possibilities include are as follows. 1. Requiring customers to pay part of their sale value in advance of the goods being spent. Agreeing to offset amounts owed for the purchase of goods against amounts due for goods supplied to same business. Requiring third-party guarantee from financial sound business such as bank or parent company. Example nga yung credit insurance or yung factoring. Making it condition of sale, the legal title to the goods is passed to the customer until the goods are paid for. And lastly, taking out insurance to cover the cost of any legal expenses incurred in recovering the amounts owed. So, thank you.
Good morning to our professor and classmates. I'm Princess Rica Correses. I'm here today to talk to you about managing cash. First, what is cash managing? Refers to optimum utilization of cash to ensure liquidity and profitability of business. It is thus concerned with the collection, disbursement, and investment of cash in efficient manner. Also, why is cash management important? Cash management is the process of managing cash inflows and outflows. This process is important for individuals and businesses because cash is the primary assets used to invest and pay any liabilities. Next, cash budgets and managing cash. It is to manage cash effectively. It is useful for a business to prepare a cash budget. This is a very important tool for both planning and control purposes. Cash budget. For examples of cash budget. Short-term cash budgets will look at items such as utility bills, rent, payroll, payments to suppliers, other operating expenses, and investments. Long-term cash budgets focus on quarterly and annual tax payments, capital expenditures, projects, and long-term investments. Those are examples of cash budgets. Managing cash. Once the payment of a liability is due, managing the timing of those payments is what helps a business maintain a healthy cash. The example of managing cash is if a company experiencing a cash flow shortage, they may choose to delay accounts payables in order to conserve cash. Meron po tayong cash management strategy. First is receivables. Receivables means receivable management refers to the planning and monitoring of debt owed to the firm from a customer account professionals working in finance and accounting departments, such as finance managers, may use this concept to grow sales and increase profits. Management of receivables is also known as payment collection, collection management, accounts receivables. Next is collections. Collections management. The cash management refers to the process of collecting and managing cash flows. Cash management can be important for both individuals and companies. It is a key component of companies' financial stability in business. Also, there is an example of collection management. Collection management encompasses a range of measures. They begin at the earliest stage of accounts receivables. Next is payments. Payment management, a process that involve. There is a process that involve in and payment management, reviewing supplier invoices, confirming or challenging the listed details or pricing. Next is capitalizing on opportunities for obtaining discounted pricing, such as early payment. Next slide, receivable management. Receivable management refers to the planning and monitoring of debt owed to the firm from a customer account, professionals working in finance and accounting departments, such as finance managers, may use this concept to grow sales and increase profits. Next slides, collections management. Collection management refers to the systems, methods, and procedures that a business has in place to oversee collections of unpaid bills from customers. Next is payment management. Payment management is a process that can involve reviewing supplier invoices, confirming or challenging the listed details or pricing, capitalizing on opportunities for obtaining discounted pricing, such as early payment. Next is investment objectives of cash management benefits. First, optimum cash balances. Optimum cash balances, it means there should not be in excess or there should not be in shortage. So we are anticipating and calculated it would be making cash budgets and cash flow statements to what would be the requirements of cash next year or in our business, and deciding what would be the optimum cash balance other than the keeping the precautionary and speculative as well. Another investment objectives of cash management is from collection from debtor. From collection from debtor, it means debt collections is the process of pursuing payments of money or other agreed upon value owed to a creditor. The debtors may be individuals or businesses. An organization that specializes in debt collections in known as a collection agency or debt collector. Next is investment of excess cash to earn profitability. They are the same in optimum cash balance. Also controlling cash inflows and outflow. Also meeting payment schedule. They are all the same. Motives for holding cash. Transaction. Cash is required in business to meet operational expenses like utility bills, salary and wages, traveling expenses, repair and maintenance, accounting expenses, taxes, etc. Also, cash has been described as the lifeblood of a business. Next is precautionary motive. Cash is required in business as provision to meet unexpected contingencies in shortened period of time. This could lead to an expected large receipt not arriving. By holding cash, the business could still retain its capacity to meet its obligations. Similarly, if there is some uncertainty concerning future outlays, a cash balance will be needed. Next is speculative motive. As you can see to the picture, uh, cash should also be kept to grab profitable opportunities of investment or profit booking as and with this the price are low or favorable. Also, in the next slide, operating cash cycle. For a business that purchases a goods on credit for subsequent resale on credit, such as a wholesaler, it represents the period between the outlay of cash for the purchase of inventories and the ultimate receipt of cash from their sales. Makikita po natin sa picture na meron po tayong mga label or flows. Ang nauuna po dito ay first is purchase of goods on credit, payment for goods, sales of goods on credit, cash received from credit customers, under po siya ng inventories, turnover period, at sa lahat po ng iyon ay meron po tayong tinatawag na OCC, Operating Cash Cycle. OCC is the time between paying of goods and receiving the cash from the sale of those goods. The length of the OCC has a significant impact of the amount of funds that the business needs to apply to working capital. That's all. Yun lang po ang report ko tungkol po sa managing cash. Thank you po.
Managing trade payables. So one of the factors that need to be considered in working capital management is the trade payables or accounts payable. So next slide po, please. So what is trade payables? Trade payables is defined as an amount billed to a company by its suppliers for goods delivered to or services consumed by the company in the ordinary course of business. So, examples of trade payables include raw materials purchased on account by the manufacturers and ingredients purchased by cafes and restaurants on account. So, this liability usually appears on the company's balance sheet under the heading Accounts Payable. So, next slide po. Why do we need to manage trade payables? Properly managing trade payables is essential to ensure that you remain on top of payment deadlines and keep your credit score intact. So companies that effectively manage their trade payables can improve their working capital, reduce their cost of goods sold, and improve their overall profitability. It can help companies to better understand and control their spending on inventory, raw materials, and other inputs. It can also help companies to improve communication with suppliers and negotiate better payment terms. So in short, effective trade payable management can lead to a healthier bottom line for the company. Next slide po. So most businesses buy their goods and services on credit. So before we go deeper, let me first discuss the benefits and disadvantages of taking credit transactions. So disadvantages of taking trade credit includes the following. First, it may incur additional administration and accounting costs. It may not be as well treated as those who pay immediately. So when goods are in short supply, they may be given lower priority. They are also less favored in terms of delivery dates. And customers may even have to pay more when credit is offered. So in most industries, trade credit is the norm. As a result, these disadvantages do not normally apply unless or perhaps the credit facilities are being abused. Benefits of taking credit. So first benefit is interest-free loan from suppliers. It can also provide a more convenient way of paying for goods and services rather than paying by cash. It also results to economic gain from paying later rather than sooner for goods and services, especially during a period of inflation. So now let's move on to next slide, please. Taking advantage of cash discounts. So this topic is very relevant for companies which have purchase departments, purchase managers, or procurement managers. So it is their job to make sure they avail of cash discounts. What is cash discounts? Cash discount is an early settlement of accounts where the supplier offers a discount that if you pay within 10 days of the date of purchase, you will get, for example, 2% or 3% off, unless you will pay the total amount in, let's say, 30 days. So remember, there are two types of discounts. One is known as trade discounts and the other one is cash discounts. So you have seen outside in malls or in shops that say 20% off. So that 20% is for everybody. So that is an example of trade discounts. We will not be elaborating trade discounts because this is not recorded in the books of accounts. So let's focus more on cash discounts or early payment discount. So when a supplier offers a discount for prompt payment, the business should consider the possibility of paying within the discount period. It is advisable to avail the said discount. So let's take, for example, 2/10 and over 30. So let's say today is July 1. I am selling goods on credit to you. So I'm selling goods on account in the amount of 100,000. So my credit terms are 2/10 and over 30, which means I'm giving you a credit period of 30 days. So you can pay me until 30 days or until July 30. So you buy the goods from me, don't pay. Pay me after 30 days. But if you pay me within 10 days, it means on or before July 10, I'm going to give you a 2% discount. So it's up to you. If you want to pay less, pay it within 10 days. So instead of paying 100,000, you will pay only 98,000. But if you don't want to pay less, pay me within 30 days in full amount. So what will happen if you don't avail the cash discounts? What is the cost to the firm? Next slide, please. Now I'm going to discuss what is the annual cost of not availing such discount, and you will be surprised with the result. In computing for the annual cost of not availing cash discount, we have 365 divided by total days minus the discounted period multiplied by percent of discount over 100 less percent of discount. So as you can see, 365 is divided by the total discount given of 30 less 10 multiplied by 2, which is the percent of discount over 100 minus 2. So that is the percent of discount. So 365 over 30 minus 10, which is 20, multiplied by 2 over 100 minus 2 is 98. So equal to 365 divided 20 is 18.25. And 2 over 98 is 0.02040816. So 18.25 times the 0.020 for 4816 is equal to 0.372449. So if we are going to convert it in percentage, that would be 37.24. So apparently, it looks like we are not getting, or if we are not getting or availing the 2% discount, and let's say we're buying every month on credit, so in 12 months, we will be losing 24%. But the compounding effect makes it 37.24, which means you are losing or you are paying more than what you should be paying. Next slide, please. Controlling trade payables. So to help monitor the level of trade credit taken, management can calculate the average settlement period for trade payables ratio. So this ratio is calculated by average settlement period for trade payables is equals to average trade payables over credit purchases times 365. So again, this provides an average figure, so which could be somehow misleading. A more informative approach would be to produce an aging schedule of for payables. So next slide, please. This is an example of aging payable summary report. So this look like almost the same with the aging of receivables as presented earlier. So this report can help you manage your cash flow and budget and negotiate better terms with vendors. It can also help you prioritize which bills to pay first and prevent you from incurring any late fees. Thank you.